Support and resistance is one of the most commonly used concept in technical analysis, right? And in this video, I'm going to show you how to use support and resistance to get high probability trades in the market. So here's what you are going to learn. Number one, the common mistakes that you need to avoid when trading support and resistance. Number two, how to identify powerful support and resistance zones. Number three, how to get high probability trades in the market. And as a bonus, I'm going to show you how to combine support and resistance and the RSI to get better chances in the market. What is support and resistance? Basically, support and resistance is levels in the market where the market have been reversing on and is likely to reverse again, just like these zones right here. You can see that the market have been reversing on these zones, and most of the time, if the market comes to a zone where it have reversed on, it will likely reverse on that zone again. Just like what you see on this point right here, the market have been reversing on this zone, and if the market comes back to this zone right here, we are going to be looking for the market to react again on this zone. So the market will either bounce on this from this zone here. So we're going to be looking for things like the reversal patterns that we are going to need to see if we want to see the market bouncing from this point right here. So the question that we all have is, can you make money with support and resistance, right? If you look into the market right now, if you go into your charts and look back into the market, you are going to see that most of the time the market will always react to a level which it have reacted on earlier, right? So for example, you can see the market was moving right here and then reversed from this zone. It went up and reacted from this zone. It came back here, reversed here, went up again, reacted on this zone, come back, reacted here, go up, reacted, go up here, comes back to this zone, reacted, go up, reacted again. So if the market at some point comes back to this zone, there's chances that the market will likely reverse on that level again. Why? Because if you look back into the market, you have been seeing that the market have been reversing on all those zones that it have been reacting on. So if the market comes back to that zone, there's chances that we can make money. So what we need in the market is just to see something that have been happening before, and that is likely to keep happening. That's what we follow as traders. That's how we create our strategies. So you need to make sure that if you see something happening over and over and over again, that thing can always happen again in the market. So that's the concept of support and resistance, right? So before I dive deep into how to trade support and resistance, let's talk about the common mistakes that you need to avoid when trading support and resistance. Have you ever heard this phrase which says, the more times it's tested, the stronger it becomes? So according to books that we read on trading, most of them tell you that the more times the market reacts to a zone, the stronger that zone becomes. But I personally think that this is not true. Let me show you some examples right here. If you look into this market right here, you can see that these zones where the market have been reacting on, right? The market have been reacting on this zone for a very long time. So if this was true, this zone right here should be very, very strong right here. But if you look back into the market, what you can see now that the market have broken past this zone at this point and it went all the way down. So what I'm saying is it doesn't mean that all the time when the market is reacting on that market, the stronger it becomes. I think that it's best for you to try and catch the first or second test of that market. This is the strongest move where the market is likely to be reacting on the market. And the reason why I say that is, if you look at this right here, you can see that when the market reacts for the first time, when it comes the second time, it usually gives you a bigger bounce rather than when it is moving over and over and over again, right? So the second touch right here, or the third touch, is the touch that you want to catch and try to place your trades. The more it keeps tested, think about this, the market will likely go up or down each and every time, right? So the more it's tested, it simply means it's likely to be broken as soon as possible. So it's best for you to catch the first move or the second move. Mistake number 2 is treating support and resistance as lines, not zones, If you treat these as lines, there's two things that can happen. It's either you are going to miss the trades that you are supposed to take, or on the other hand, you can also get stopped out by putting your stop loss very close to that line, because you believe that it's a line, so the market will come directly to the line and then pulls back. So if you look at this, you are going to see that the market was pulling down and then it reacted on this zone right here. So if you were treating this as a line, instead of getting your buy orders here or here when the market retested this zone, you were waiting for the market to come back into the line directly before you place your trade. So you miss this good trade and you also miss this good trade, simply because you are treating this as a line, not as a zone. Mistake number 3 is placing your stops in the zone. This is a very common mistake, and let me show you how this happens. So let's say you see the market reacting on this zone right here. You see the market reacting here, pulls up again, and then now it comes back into this zone, and now you want to buy here. You see your indecision candles right here, and then you buy, right? And instead of putting your stop loss below the zone, a space below the zone, you just put your stop loss right on the zone at this point right here. This is not a good way to place your stop loss, because the market will always come and try to retest those zones. Remember, I said the market doesn't reverse because of a flip of a coin. It reverses because of people filling in their orders, and there's a lot of things that happens on that zone. So you need to make sure that you place your stop loss a little bit a distance from the zone, so that when the market comes back to the zone, you can give the market time to move in the zone before moving in your direction, if it is about to move in your direction. Right? So with that being said, let's talk about how to get high probability trades in support and resistance. Right? So step 1 is identify your OTZ. So what is an OTZ? The OTZ is the optimum trading zones. These are the support and resistance zones with the highest chances of winning. So let me show you how this works. So once we have this zone right here, which we have tested, let's say 2 times, and then broken, and then the market is coming back into that zone, or once we have a zone which the market have moved into and then moved a bit far from it on the first time, and then the market is coming back into that zone right here, it's that zone which is also called the optimum trading zones. So the optimum trading zones are the zones that have been tested multiple times, but you want, if it is tested multiple times, you want to make sure that for some of the time it was broken and then the market is coming back into that, or you just want a zone which the market have moved into and then make a strong move from that zone right there. That zone have a chance of reversing the market when it comes to that zone again. Once you do that, step 2 is find your entry triggers. So what is an entry trigger? An entry trigger is something that you need to see before placing the trade, right? So on that exact same example, you are going to see that on this point we have our optimum trading zone. We see that the market have been moving far from this zone. So when the market comes back here, I'm looking for the market to make again another at least big move from this zone. But before I place a trade right here, I want to see an entry trigger. What is an entry trigger? It's a candle which have very long wicks, either to the downside or to the upside. So on this case right here, I don't have that one, but this was a good one right here. If I get another one, so I will show you. This right here is called a rejection candlestick. Right here, before placing this trade, right, the market is in the optimum trading zone. It's in the good support and resistance zone. Before placing the trade, I need to see a candles with long wicks, either to the downside or to the upside, before I place the trade. Once I see that, that's when I buy, and then I put my stop loss below the zone, and then my take profit before going up to the upper zone. So I'll put it at least at this point right here, and then expect prices to either move up to the take profit. That's how you get a high probability trade in the market. First of all, identify a zone which is very clean, which have the market moving from that zone, and then you see that this zone have rejected price at least once or 2 times before. Then when it comes down there for the 3rd time, that's when you want to place the trade. Number 2, on that zone you need to see a rejection candle or an entry trigger. If you see a candlestick pattern like a bullish engulfing candle or a hammer or anything like that, that's when you place your trade, and you put your stop loss below that zone, and you take profit where you want to take the profit, right? So as I promised you a bonus, let me show you how to use the RSI to add to your chances of winning when trading with support and resistance. So I want to show you how to combine the RSI and support and resistance so that you can get a high probability trade. So the RSI is used to show strength and momentum in the market, right? So we all know that in the RSI, if the market is oversold, right, we know that it's time for you to get a potential drop in the market. So you want to be, so you know that there's more buyer. So with the RSI, you know that if it goes above the oversold part here, there's more buying pressure, right? So this is a mistake. There's more buying pressure. The market is still looking to go up, right? And then if the market goes below the oversold, there's more selling pressure. The market have been selling very, very much heavily in that period of time, right? But for some reason, people want to buy and sell with the oversold. I think if you want to get high chances, you want to combine this with the support and resistance, and let me show you how you do that. So right here you can see that we have support and resistance in the RSI, and I want you to see something right here. When the market reversed on this first point right here, it made a big move, and I said this is called an optimum trading zone. And then if you look into the RSI, you are going to see that the RSI is below the level 30, right? And then when the market comes back into that zone, you are looking to buy, right, at this zone. Now before buying, you want to look now into the RSI, and you want to see is there any still much of selling pressure, because the RSI going below oversold, it's because of selling pressure. So now you can see that here the market moved, but it didn't go past this zone right here. So the market moved into this same zone, but the RSI now shows you now there's less selling pressure, so buyers might take charge and pushes prices up. That's when you buy at this zone. Or on this zone again, when it comes back into that same support and resistance zone, you can see the RSI is showing you now there's less selling pressure here than here. That's when you get something called a divergence, right? If you know something like this, it's called a divergence. You can see right here the RSI is now coming out, is coming from the oversold. Now it's now in between, and then you are here, you are expecting prices to bounce because there's now less selling pressure at this point than there was here. So if this zone was able to hold this much selling pressure, it should be able to hold this selling pressure, because the RSI is showing you that momentum is shifting to the buyers. So that's how you use the RSI and the support and resistance to get a high probability trade. So there you have it, friends. If you want to learn more about trading, you need to click the subscribe button, click the like button, and make sure you leave a comment down below. Otherwise, thank you for watching this video. I'm looking forward to see you in the next video that is coming up on the screen right there. You are going to learn how to grow a small trading account in So in that video, you are going to learn how to grow a small trading account. Go ahead and click that video and watch that video until the end, because there is so much value in it. You are going to learn it and you are going to love it. Thank you for watching, and I'm going to see you in the next one.